Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, June 7th, 2017. For the second consecutive week, we've seen inflows into the conventional fund business. I'll talk a little bit more later about the ETF side of the business. But we saw about $5.7 billion enter the fund business. And it really was more on the conservative side as people were getting prepared for what many are terming the Super Thursday events, which just passed yesterday. And basically, they were looking at Comey testifying to Congress. And they're looking at the ECB coming out with their bank policy, which remained unchanged, but got a little bit more hawkish in tone. And then also they were looking at the UK parliamentary election, which actually sent everybody for a little tizzy early this morning, but markets are looking just fine right now. Actually, as we look through the week, even though people were concerned and they did go a little bit towards the conservative side, we actually saw that the S&P and the Dow actually performed quite nicely for the week. It went up, so maybe it was a little unfounded, kind of the foot off the pedal reaction. Let's take a look at our macro groups to see how it panned out and what happened as far as the flows go. Equity funds saw about $3.1 billion. I told you investors got conservative. Taxable bond funds investors, although, put in about $3.5 billion, and muni bond funds took in about $900 million, and money market funds so about $4.5 billion entered their coffers. Let's take a step-by-step look at the macro groups to see what happened in there. Let's start with equity funds. Equity funds actually had a pretty nice return, as I was saying before, about 0.95% return. Third consecutive week they've seen plus side returns, but it's the 11th consecutive week that fund investors actually were net redeemers. About $3.1 billion left their coffers. As has been kind of the tune for the last several weeks, domestic equity funds lost the biggest share, about $2.9 billion. It's the 23rd consecutive week they've seen outflows, and about a 0.95% return on that group. And non-domestic equity funds saw just about $220 million in outflows, so not that much to write about. It's the fourth week in five, though, they've seen outflows from the conventional fund business, and again, they had a 0.95% return. So again, it was pretty good overall. If we take a look at a group-by-group breakout, though, we see large cap funds, as far as classifications go, actually lose the biggest chunk. It's been the trend for quite some time, about $1.4 billion left their coffers. And then we looked at the international equity funds, and again with the UK, having their elections and the bombing that just went off by the London Bridge over the weekend, people actually were a little concerned. So we saw about $119 million in outflows. Again, not that much to write home about. Let's take a look at our equity ETF side and see what happened there. For the second week in three, we've seen outflows, so the authorized participants are certainly behaving the same way as conventional fund investors are, at least for this week. $1.9 billion left their coffers. And what we saw was Spider Gold. Remember I said people got conservative, so I think what people were doing was a safe haven play. Spider Gold took in money, but only about $737 million. iShare Consumer Staples Select Sector Spider Fund ETF actually saw about $729 million in inflows. And as you can see on the screen, the the iShare Russell 2000 actually took in money, so a little bit of head scratcher there. At the bottom of the barrel, though, as we might expect, people again taking the foot off the pedal. Spider S&P 500 saw the biggest outflows at $2.4 billion, and the second largest amount of outflows was seen by iShares Edge. MSCI Quality Factor ETF, which saw about $700 million in outflows coming out of that group as well. Well, let's take a look now at what happened in the fixed income universe. And this is where I was saying people were being a little bit more conservative. Seventh week in eight, we've actually seen inflows into the conventional fund business. On the fixed income side, $3.5 billion this week, fourth consecutive week of net inflows. Fourth consecutive week of positive returns, 0.26%, and we've averaged about 0.25, about 25 basis points in each of the last 4 weeks. That's not bad, a 1% return per month on a fixed income fund. Not looking too shabby out there. Let's take a look, though, a little bit closer. We had corporate investment grade debt funds kind of take in the lion's share, about $2.6 billion. 25th week in 26 that they've seen net inflows, and high yield funds actually took in about $355 million. So this is kind of my statement. There was a risk off on the equity side, but on the fixed income side, it looks like people put the pedal down to the ground and were willing to take on a little bit more risk. We did see that loan participation funds, which is a subset of the corporate investment grade debt funds, basically taking about $294 million. So certainly people are still remaining somewhat concerned about inflationary expectations. Of course, the Fed meeting come up on June, I believe it's 14th. It's the 29th week in 30 that they've actually seen net inflows for loan participation funds. So we only saw one group that lost money, and it was a mixed asset fund group, which has been slotted into the fixed income group. Basically, we saw balanced funds lose about $229 million for the week, and so that was kind of the story there. Let's take a look at what the fixed income investors were doing. They pretty much had the same thing. So fixed income ETFs basically had the same thing, about $3.9 billion of inflows. Fourth consecutive week, they've seen that new money come into that group. At the top of the group, we saw the iShares JPM US dollar emerging market bond funds taking about $1 billion. iShares 20+ Treasury ETF. Here's some of that conservative play. They might have been building some inventory for people to buy, but basically we saw the 20+ Treasury ETF taking about $835 million, and the iShares 7-10 Treasury bond ETF was the big loser. So kind of a head scratcher there as well, losing about $162 million in outflows. So overall, we did see some conservative moves, especially on the ETF side where they padded more treasuries. But really, if we dug down a little bit deeper on the ETF side, we saw that the international and some of the more riskier assets, corporate investment grade, high yield, and flexible portfolio money funds took in money. So let's take a look now at muni bond funds, and they've actually been on a pretty good roll recently. $871 million net new money. Eighth week in 9, they've actually taken in money, and this is the fourth consecutive week they've seen plus side returns, this time to the tune of about 0.22%. The big winner there, we kind of check for large and intermediate and high yield and stuff, but really just aggregate them all together into national munis, took about $840 million. That means single states probably had about $31 million. In net inflows. And really, we're attributing this still to the Washington drama that's going on. We got the Comey investigation going on. Russia is still a big kind of issue in the news. And so investors know that as long as this kind of pall, this cloud is hanging over Trump, it may be more difficult for him to push through those tax reforms. And I think that's why people are betting on the muni bond fund side. Let's take a look now at money market funds and see what that brought us. For the fifth consecutive week, we actually saw inflows, $4.5 billion into net new money coming into that group. Taxable money market funds took in about $3.5 billion, and we have tax-exempt money market funds that took in about $1 billion. And if we break out the taxable bond funds, we saw that the institutional investors redeemed only about $300 million, but the retail investor actually put about $3.8 billion back in taxable money market funds, and that kind of makes sense if they were looking at the kind of uncertainty of all the things that are going on. Well, that's it for me this week, but let's take a look at what happened this morning, so to speak. We had some feedback what went on. We learned that during the British elections, basically we ended up with a hung parliament, and so there's some concern out there. I think a lot of people, I got called up late last night by a journalist, and they asked, what do I think was happening? And I told them that I didn't think it was that big of a deal. It's going to take a while for Brexit to come around. It's going to be a difference between a soft or hard Brexit, and it looks like it's actually maybe inching towards a soft Brexit, which obviously could be a benefit for the markets and the like that. So I'm not sure that's that big of a deal, and certainly the markets haven't reacted too heavily. At least markets still open now, but at least today the markets on Friday seem to be going pretty good. Not gangbusters, but certainly not taking a big dive that I think many had expected. And of course, we have round 2 of the Comey testimony to Parliament, to Congress. And that might bring some other things as well. But we'll know more next week. You can join us next week when one of our analysts will talk about flows of the week. Or if I didn't cover the areas that you wanted to cover, you could always go to our website at www.lipperusfundflows.com and do a deeper dive yourself. Thanks for joining me. My name's Tom Roseen, wishing the best in your wealth planning and creation.